Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He's speaking to us from Alabama. Welcome back to the show, Tim.
Jim, thanks as always for having me.
The first time I came aware of your town, by the way, is I was watching the Weather Network, and I think it was Hurricane Sally was going to roll right over your community.
Oh, yeah, Hurricane Sally, and it did. It rolled. That was the first hurricane I actually, full-blown hurricane I actually sat through. It's quite interesting. But, yes, it hit us last September, dead on.
And I called it Mustang Sally. Hold on. It's going to be a rough ride.
Yeah, it was, nobody was expecting that. It was supposed to be, nothing to it, and it turned out to be, somewhat of an event. There may be a correlation there with the market. Who knows?
I was going to say something that no one is talking about, the current Fed operations. What's going on there, and why isn't anybody talking about it?
Well, that's a good question, and I don't know what's going on, but it's obviously a sign that something is not right. But you recall everybody remembers back in September, I forget the date, but it was I don't want to say because I don't remember the date, but it's September of 2019. Remember when the Fed came out and I think they actually announced that they were going to do these, repo operations for a short period of time, and then it just went on for another week, and then another week, and then it went on, just went on and on and on, and everybody was talking about it. Remember, it was called the non-QE QE, and it got a lot of attention, right? Well, I was seeing some things in some charts, some of the leading indicators and some of the stuff that I'm watching very closely, and someone said, brought this to my attention, and I got to looking at it, and I don't know exactly what's going on, but something is not quite right, because they're doing what they call reverse repo operations. And I don't think this means that we're necessarily at the end game when we could just fall off the cliff, but I think what it does mean is that we're in an environment, like I said, where something is afoot. And given the extension of this cycle, given the current environment that we're in, it does make for a delicate situation. And, technically the market is weak, so if something goes wrong, it could be the straw that breaks the camel's back. And I guess what it amounts to is how successful are they at holding this and their operations? Because, it's, like I said, it's kind of like, I don't know how to describe it. I mean, it's just a delicate situation with what they're doing, and something is wrong. To put it in perspective, let me give you some numbers I downloaded from the Fed site. And it's not unusual for them to do these operations to, add liquidity or whatever, collateral in the market and that sort of thing, as I understand. But the numbers are escalating. And in January they did, and this is in total, this is for the month, they did $18.36 billion in reverse repos. In February they did $23 billion. In March they did $432 billion. In April they did 1.4 trillion, and in May they did 5.5 trillion. Now let me put that in perspective a little bit. These operations, they're short term, like one or some of them are a couple of days or that sort of thing, but they're doing the same thing over and over and over and over. And so the point is, when you look at it cumulatively, you can see that whatever is going wrong, it doesn't appear to be fixing anything, and it's escalating. So I looked just before you called, so far this month, in 3 days, they've done 1.3 trillion. in these reverse repos. So I don't know, but something's not right. And combined with the technicals, it makes me suspicious. I think that one aspect of it may be, or maybe it's just a side benefit or goal, or whatever, is to try to keep these short-term rates from going below zero. I think that's just maybe a one small aspect of it, but something is up with it.
Now, when an operation like this is underway, and very quietly, I haven't heard anything about it publicly, and yet you're talking about $1.3 trillion. That's not chump change that you would spend on lunch. Why would they keep it quiet? Is it they are scared it could panic the markets?
I don't know. I mean, maybe the market's just complacent to it. I mean, I don't know. Look, I don't have those answers. I have no idea. But maybe it's just like anything else. It's like, you become immune to the news and it just becomes a non-event. It's like, oh, ho hum. I don't know. But I don't have that answer. All I know is that it started and it has escalated. And, why? I don't know.
If interest rates, on one hand, they're saying if inflation is going to be rampant, that boosts interest rates. Yet here you were talking about an effort to keep them from going below zero. Why the effort if they're worried about higher interest rates?
Well, I think they're trying to walk a line here. I think they want, on the one hand, they do want to keep rates low because I don't think the market, first of all, I don't think the market can support substantially higher rates. I do think there is an effort to keep the rates low, but I think they don't want them to go below zero. And what I noticed is that some of the stuff that I'm looking at, key indicators and kind of, gauges on the dashboard, if you will, of what's really going on beneath the surface, is that, I think it was a 6 month, I think it's a 6 month T-bill rate had gotten all the way back down to the same level that it was at in March. I believe it was March or April. I believe it bottomed in March of 2020. It was sitting at that same exact level when this started escalating. And so I think that, maybe it's coincidence, but I think there is, like I said, somewhat of an effort. Yes, we want low rates, but we don't want them that low type thing. We don't want them below zero. We just want them, so I think maybe there's an effort to maintain status quo, if you will.
Bitcoin, what do you see going on there?
Well, I guess it was probably a month ago in the interview before last, I said we would watch it. And then I think we may have touched on it last month or last time, but we really didn't elaborate. But I said that, I felt like it was, we would watch it for structure, for setup. And, it just, when we talked last week, it was already over. I mean, it already just bada bing, bada boom. And, it had peaked and it had dropped from, I don't even remember what the numbers were. It was 60,000 or something to down into the 30s. So it fell quickly. And I think it's reflective of the risk we face with other asset classes. I've been saying that I think that everything was going to peak in close proximity and come down together. And when I say close proximity, it's just like equities peaked in October of 2007, and then I think it was in July, if I remember right. I'm saying that from fuzzy memory, but I think it was in July when commodities peaked. So, that's close, but it all did come down together. And that's the kind of thing that I think we're seeing. I think it is a warning, and I suspect that Bitcoin may have already peaked. I mean, it happened so fast we didn't even get a chance to talk about it. But I think it is a warning of the risk we face with all this other stuff.
Now, a lot of people are saying with Bitcoin and other cryptocurrencies, governments at some stage are going to turn to digital currency, ban cash, and also ban cryptos at the same time because they want 100% control of your finances. Any thoughts there?
Not really. I mean, that's kind of speculative. It seems like it would be hard to do away with the dollar, but and hard currency. But I do think, this is just me talking. I have no research on this, but just my opinion. I tend to agree with that. I do think that's a trend that they want to try to push. Can they do it? Will they do it? How will it? What does it entail? I don't know. I haven't given that a lot of thought or looked into it, but yes, in general terms, I think that's probably a goal. But, is it realistic, and can they do it, and how far out is it? I don't know. I don't know the answer to that.
Yeah, and some people have said, so if they ban cash, humans tend to invent their own currency. In prisons, it was cigarettes. Even if you didn't smoke, they were traded and had a value. We'd find something, I don't know, clamshells or something to trade to represent that. Plus, what if we get into just pure swapping stuff? I'll give you so much of this, and you give me so much of that back. Then the government can't track it or tax it.
Right, and again, that kind of gets into the speculative realm. But how do you pay? The simplest things. How do you pay the kid next door $20 for picking up limbs out of your yard? Or how do you give the kid who graduated high school, whatever, $100 for his graduation? How do you perform the simplest of transactions? The nickel and dime transactions without cash. I mean, if everything was 100% cashless, then I don't know. It seems like it. I don't know. That's like I said. I tend to agree with it, but I don't understand how we would transition into a 100% cashless society.
We'll have more with Tim Cyclesman Wood right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, commodities, with the high prices that we're seeing for just about everything, copper, steel, lumber, is this just the beginning, and are we headed to hyperinflation, as so many people seem to be saying?
Well, it's certainly been inflationary in the interim. There is absolutely no question about that. But I'm sticking to my guns that no, I think this has all been part of the post-COVID illusionary recovery. And I say illusionary recovery because I firmly believe that's what it is. I think this has been by and large on the back of shortages and not because of demand because of a growing economy, and those are two different things. I have said, I think in recent interviews, that I think that this is going to be it's kind of like the peak oil. Everybody thought oil was just going to go up and up and up, and the higher it goes, the higher people think it was going to go, and I'm not buying that. I mean, I think that this is all going to, like I said, all asset classes, I think the risk we face that no one sees is that all asset classes will peak together and it all comes down together. I think that these higher commodity prices are a tremendous burden on the recovery. And, at some point, I think it's going to reach the tipping point where, like I said, they just run out of steam and it stifles what recovery we have. And then I think it sets us up for everything to come down together. So, is it long-term hyperinflationary? I'm not in that camp. No, sir, not at all.
Now, Gerald Celente, in his interview for This Week in Money, which runs this weekend, said consumer spending is up according to the government, but he said it's not because people feel more confident and are buying frivolous things. He said it's because the basics they need to buy are more costly.
I was already ahead of you when you made the comment. My mind had already gone there, and I agree with that. I agree with Gerald 100%.
Is there any way for us to take advantage of this and to avoid any damage from this inflation?
Well, I mean, there's nothing you can do in the interim. I think that, the way I look at it is people wanting to do, if I was wanting to build a home right now, I mean, I wouldn't do that because of the price of lumber, and by the way, I think there's a good chance that lumber prices have peaked. But I mean, purchases like that are commodity related, people wanting to say redo their kitchen or something. Well, why do it now? So yeah, simple things like that I think can be put off and avoided, and there'll be a better time to do things like that down the road when prices come down, and I do think they will. I did a long piece in an analysis of lumber prices in the recent letter showing that. But anyway, but as far as the purchases that you have to make, I mean, you have to go to the grocery store and buy, food and you have to buy gasoline and those sort of things. Well, I guess you can limit, say, well, I won't make that trip. But as far as, the necessities, no, there's nothing you can do but pay the price.
Is there anything happening with the U.S. dollar?
Yes. The dollar, I think, it should be moving into what in my world is an intermediate degree low. And that's going to set the dollar up, I think, to move higher. And again, that is a contrary view with what everybody is thinking, and that may correspond, it may be setting us up to correspond, with a peak in the commodity prices and maybe other asset prices as well. The jury is not, or let me say this, the evidence is not all the way in yet, but I think the dollar's in the ballpark for an intermediate degree low. And then that will confirm, I think, some higher degree lows. So I think the surprise may be bottoming of the dollar.
Crude oil?
Crude oil, just like the rest of the commodities and lumber and so forth. Right now it's up and away, but I think that again it's going to be when we get the proper structure, and I think it's going to peak with all the other assets, all the other asset classes, and be poised to come down with everything. I think it once whatever it is that sparks the turn, I think everything comes down together. And I also maintain, I know it's probably contrary thinking. I don't say it just to be contrary. I say it because it's what the work suggests. But that coincides with the thinking that this really hasn't been a true recovery coming out of this, this post-COVID era. It's just, I think it's an illusionary bounce. And once it runs its course and we turn down, like I said, with proper structure, and something is wrong out there. I mean, we can see it. Let's go back. I don't mean to digress or ramble, I feel like I am, but going back to, the repo operations that we're seeing, something's not right. Something's not right. And like you said, we have this increase in cost. I mean, that's not, and incomes are down. There's people still not working. At least around here, I see it. I go to restaurants that are still closed, or I say I go to them. We'll attempted to go to them. People are still not working. And, the economy is not what we're being led to believe that it was. We're still struggling to get back to the levels of the worst recovery since the Great Depression. And then you add to that these increased prices, and yeah, it is what it is for the moment, but I think reality is going to set in, and when it does, we'll see it with structure, and I think people will look back on this and say, wow, what were we thinking?
Well, I'm looking at the major stock markets right now. The TSX exchange in Toronto is outperforming New York. Does that tell us anything about the U.S. markets?
I don't know. I haven't done that study. I don't know, but I think the Toronto market, I haven't looked at a chart, but I think that it may be outperforming now. But when it all turns, I think it all turns. I can do some analysis with that and maybe give you an update next time. But as far as I think where you're going with that is that if it's kind of like the theory with Dow theory, where you have a non-confirmation. In other words, if the Toronto market is outperforming the U.S. market, is that telling us that the U.S. economy or the market is weakening? And, perhaps so, but I don't know without looking at the charts. But I will say this, there's such a disconnect at this point with the economy and the stock market that, just off the cuff, I don't know that I'll draw any conclusions about that at this point. That it's a reflection of a weak one having a weaker economy than the other. I think it's just more a reflection of one turning or maybe struggling a little more than the other versus a reflection of the economy.
Tim, thank you so much for chatting with us.
Thank you for having me.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.